Ladies and gentlemen, good day and welcome to Blue Jet Healthcare Limited Q4 FY24 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Advait Badekar from EY Investor Relations. Thank you, and over to you, sir.
Thank you, Sagar. Good evening and a warm welcome everyone to Q4 and FY24 earnings call of Blue Jet Healthcare Limited. Please note, investor presentation and the financial results are available on the company website and the stock exchanges. Also, anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. The conference call is being recorded and the transcript along with the audio of the same will be made available on the website of the company as well as on the exchanges. Please also note that the audio of the conference call is the copyright material of Blue Jet Healthcare Limited and cannot be copied, rebroadcasted or attributed in press or media without specific and written consent of the company. From the management side, we have with us Mr. Shiven Arora, Managing Director, Mr. V.K. Singh, Chief Operating Officer, Mr. Ganesh Karupanan, Chief Financial Officer, and Mr. Sanjay Sinha, Deputy Chief Financial Officer. Now I would request Mr. Shiven Arora, Managing Director of Blue Jet Healthcare Limited, to provide you with the updates for the quarter and the year ended 31st March 2024. Thank you, and over to you, sir.
Thank you. Good morning and a warm welcome to all. I would like to start off by saying that as a company we were able to restructure the business successfully despite the incident, which had a short-term impact on the business. With our sustained efforts and strong business continuity plan, we were able to grow our business in Q4 compared to Q3 FY24 by 10%. We believe to have strong abilities in capital management with the key ratios of ROCE at 26%, EBITDA at 32%, and fixed asset turnover north of 5x. As a company, we are also evaluating to acquire strategic talent for R&D and business development activities in Europe, which is our key market. On the manufacturing side, while Mr. VK will take you through the midterm capex plan, but seeing the overall outsourcing trends in the CDMO business, we are also evaluating a much larger capex plan. Once formalized, we will update in the coming quarters. To share some business highlights, we will continue our strategic intent of serving innovator customers in the pharma space and marquee customers in the artificial sweetener space. Listing of the company has increased the brand awareness, and we are also able to see more inquiries and positive feedback from our existing customers. We have seen positive developments across our business segments. To start with contrast media, which is about 68% of our revenues as on FY24, our dominant segment. As you are aware, we are closely working with the industry leaders in the medtech industry and are able to sustainably increase our wallet share with our key customers both in the iodinated space for X-ray CT products and gadolinium space for MRI application. Important update. Our validation quantities for advanced intermediates in the iodinated side has received a customer approval. And the NC intermediate on the gadolinium side is gaining solid traction in the market. The second vertical, pharma intermediates, the CRAM segment, about 14% of our business, which grew by about 156% year on year. We started commercial production of pharmaceutical intermediate for our innovator customer in FY24. Our innovator customer presence in the market has been further strengthened by the label expansions and approvals in both regulated and less regulated markets, confirming our order book for the next 18 months. We also see a surge in RFPs with our other innovators across in our focus areas of oncology, CNS, and cardiovascular health. The third vertical, artificial sweetener segment, we continue our development activities in this segment since we are already supplying to marquee names in the FMCG space and pharmaceutical segment, and have demonstrated a great track record with them. There is a high likelihood to expand this portfolio in the segment and grow with our existing customers. On this note, I would pass it on to Mr. VK to give more light on our CapEx and R&D initiatives. Thank you.
Thank you, Shiren, and good evening, all of you attending the call. This is VK Singh. I will quickly take you through the CapEx that we are incurring. The CapEx cycle is mostly in step with what we had indicated in the previous call. If you recall, we were building a block at Unit 2 Ambernath, which will cater to the uptick in the volumes of our intermediate for the CDMO cardiovascular opportunity with the innovator in the PI segment. This block will also cater to the NC opportunity that we were tracking in the contrast media segment, which will be going on stream shortly. As indicated in our previous call, this block will be ready for validation in the Q1 of FY25. With regard to Unit 3, Mahad, we foresee a delay of a quarter. The plant will now be ready for validation batches in Q1 of FY26. As we speak, we are in the process of commissioning the effluent treatment plant at Unit 3. But as you know that this site is not deployed for making any product that we currently, sell, but was more for import substitution of a particular product that we import, and hence we don't foresee any material sales revenue impact from this delay of a quarter. The multipurpose block in Mahad Unit 3 will get validated by Q2 of FY26. With regard to Unit 4, that is the greenfield site, our expansion site in Morivali, here also the site master plan is ready and submitted, and all the required approvals for the commencement of work at the site have been submitted. We expect this unit to be on stream in the second half of FY27. Additionally, we had invested in a solar plant which went live in Q3 FY24. With regard to R&D, to be able to keep in step with the additional capacity of about 50% that we are adding, we have increased our R&D as well. We have augmented our scientific talent pool and also significantly increased the number of labs that we had. Several patents have been filed in FY24, and some new chemistry platforms have been added on which work has commenced, like the pyrophoric platform, the iodination platform, enzymatic platform, and a platform on which we are working for amino acids. To assist our increased focus on R&D and improve the speed of industrialization, a world-class pilot plant with versatile capability is under construction. This will help R&D in proof of concept and act as a bridge between bulk and bench production. Quickly touching upon sustainability, as a responsible company, our endeavor always is on reducing our carbon footprint and GHG emissions. With our solar plant going on stream in the previous financial year, almost 60 to 70% of our power requirement should be met from renewable energy sources. We are also consciously working on several green initiatives as far as our chemistry is concerned. We continuously strive to achieve high level of atom efficiency in our process chemistry and strive to make our industrial process and plant designs more efficient and environmentally friendly. And I'm happy to say that we have achieved good success in this regard. With this, I will hand it over to my colleague Ganesh, who will take you through the financial numbers.
Good evening. I'll first start with Q4, talk about key highlights of Q4 and then go to the full year of FY24. When you look at Q4 sale, we had a growth of 10% compared to the previous quarter, Q3. And as you are aware, Q3, there was an impact in the performance due to the accident incident at Mahad, and we are able to come out of this impact, and Q4 we are able to demonstrate a sales growth of 10%. In terms of EBITDA, Q4 it dropped approximately by 3.9%. This is primarily because of change in WIP and finished goods. If you see our P&L for Q4, the change in WIP and finished goods is almost close to 27 crores, 274 million. And there is an overheads impact, which normally gets inventorized in the previous quarter, gets released to the P&L in the subsequent quarter. So because of this, we had an impact close to 4.3%, which was offset by reduction in operating expense, marginally because of ocean freight and the power cost. As VK Singh mentioned, we are dependent more on renewable energy, and this has a positive impact on our overall power consumption. Our profit after tax is at 21.6%, an improvement of 2.3% compared to Q3. If you go to the full year FY24, our turnover is more or less flattish. It actually degrew by 1.3%. Our sales from operations of product segment is around 708 crore against the last year number of 718 crore. The sale of artificial sweetener and PI grew, and this was actually offset partially by degrowth in contrast media. The key factor on degrowth in contrast media is certain actions by the customers in terms of destocking and their plan to take a longer maintenance, which is actually disturbing the overall shipment. So today you see a variability on quarter-to-quarter dispatch, which in our opinion should get eased out after Q2. EBITDA is for the full year is 32.2%, an improvement of 1.8% compared to FY23. This is predominantly driven by reduction in raw material price, and we are also able to control our operating expense, and there is more or less a flattish trend in the operating expense. This EBITDA is before extraordinary item. We had actually classified 97 million on account of the Ahad incident as extraordinary expense. This is a conservative approach wherein we have actually taken it, the entire loss of plant and machinery is taken as an extraordinary item. As and when we receive the claim from the insurance company, this would be reversed and will be shown as a credit to the P&L. The profit after tax for the full year is at 23% compared to 22.2% for the last year, remaining flattish, but we should be growing at a healthy PAT rate of 23%. As far as the new product launch is concerned, in FY24, we launched the intermediate for pharmaceutical in the pharmaceutical intermediate segment, and you could actually see a significant growth in that particular segment. And we do expect with our new capacity, what Shevan and VK mentioned about, we should be in a position to actually optimize the capacity in this financial year. Certain general observations. In terms of raw material, we could actually see an overall reduction in the price levels during this year. Almost all of our key raw materials, we could see a marginal decline in the prices, and we believe this particular trend should sustain, and which should actually help us in sustaining our gross margin. Coming to working capital, there is a reduction in receivable. This is due to the customer mix. We talked about contrast media sales declining due to customer offtake, and pharmaceutical intermediate sale is going up. Because of this, there is a different credit term between contrast media customers versus pharmaceutical intermediate customers. And because of this customer mix credit term, the working capital has actually come down. Inventory remained at the similar level compared to last year. And with the commercialization of the new products, we do expect the inventory level to marginally go up in the current financial year. Payable also dropped predominantly because of product mix and the payment terms. And CapEx, already VK Singh has explained. We have spent close to 200 crores in this financial year, after which is capitalized plus the capital work in progress. And we should be spending at least 200 crore per annum for the next 2 years at least on the CapEx plan for our units, for our existing units. I think with this, I just open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you have any questions, please press star and 1. Our first question is from the line of Ashwik Jain from ICICI Securities. Please go ahead.
Yeah, hi. Good morning, Sanjesh here. Can you hear me?
Yeah.
Yeah, hi, this is Sanjesh here. Good afternoon all. I got few of the questions. First, Ganesh, actually you explained the reason for the lower gross margin in the quarter. I missed that. One of the reasons is that we have lower mix of contrast media. I get that, but there is steeper drop than what we thought. So what is driving this decline in the margin?
This is predominantly because of change in WIP and finished goods.
Okay.
Quarter, if you notice, if you refer our P&L, you will see the change is close to 27 crore.
Correct.
Okay. Now, this is tough accounting. Normally, the overheads gets inventorized along with the fixed valuation. So you have raw material plus overheads. So whatever overheads that got inventorized in the last quarter, this quarter, whenever this change happens, to that extent, it impacts your P&L. This has nothing to do with our actual gross margin. That is intact. But this aberration has occurred only because our finished goods stock end of the year is lower than the previous quarter.
I thought that should also capture in the other expenses, right? Because our other expenses are pretty much flattish. I know there is a slight bit of employee cost which has come down, but other expenses have remained flattish. What explains the decline in the EBITDA margin by 400 basis points?
See, like if I look at by product, the margins are almost identical compared to Q3. There is no major change. Now, the real impact is only on account of this closing inventory of finished goods. This may be offline. I can explain how this works. And
okay. So what we are telling that there is no impact because of change in the mix, because the contrast media mix has come down from 68 to 62.
Yeah.
While sweetener and pharma mix has gone up, which otherwise have a lower margin. That should have some impact, right?
So technically, like this product mix, The impact is very less. The bigger impact is more on account of change in inventory.
Fair enough. Fair enough. Next question is on the iodinated product and the gadolinium and the cardiovascular. First on the iodinated, are we still in the validation stage? So when should we expect the commercial supplies to begin? And what is the risk in the validation stage? Can it go back and tell that these needs to be optimized further so that can increase the timeline? How should we think about it?
Yeah. So this specifically on this iodinated molecule, which is an advanced intermediate from our current base, we have supplied this material for validation in the month of January, and today we have got a full approval from them. So nothing could go wrong when it comes to the product quality. I think it has been established well, and the use test trials have come out fairly positive. So scale up will happen during this particular financial year.
That's clear. And what about the byproducts to be produced from the iodine, which will come up resilient and all those things? Where are we in that process in terms of optimizing the operations?
I think with this 8 to 9 metric ton dispatch of these validation quantities, we were able to fairly demonstrate well in terms of the overall recovery cycle of the iodine. And we are very confident in terms of having a very sustainable margin on this particular product also going forward.
Fair enough. And the second, Shiven made a comment that gadolinium has seen a good pickup, while innovator initially did not see so much of a success with that product. What is driving the success right now for them, and how is it benefiting us?
So I think in the past few months it got a European approval.
Yeah.
With these regulated market approvals, we can further flood the market with the material, and they are also filing this NC molecule in the other semi-regulated markets as well. I think this will drive the future growth, and that's one of the reasons we had expanded this capacity for this particular intermediate as well.
Got it. Lastly, on the cardiovascular drug which we are supplying to the innovator, how has been the order book looking like for the next fiscal year, considering that they had a big success with the regulator, and also expected to get from the European Union as well, that should establish them being the $1 billion plus kind of a product. So what does it mean for us in terms of a pipeline for FY25?
See, the label updation, Sanjesh, and the label expansion were already approved in the US this calendar year.
Correct.
I think it happened in the month of May. After that, we expect something similar, label expansion in the European market as well. There could be an uptick in volume, but the capacity that we have now created, I think we have enough to be able to address should there be any uptick that's indicated by the customer. I think we are in very good state as far as the traction that the molecule is getting and the capacity that we have now created in Unit 2, Plant 6, which is going to go on stream this quarter itself.
So how much capacity are we expanding with this new CapEx?
This is a multi-product block, and it's not only for the innovator. We have a couple of other products, so it will be not appropriate to give or dedicate the whole capacity for one particular customer.
Fair enough. Just one last quick.
Sir, may we request you to return to the question queue for any other follow-up questions, please?
Okay. Thank you. Thanks, Shiven and VK for answering all the answers.
Thank you. The next question is from the line of Sudarshan Padmanabhan from JM Financial. Please go ahead.
Yeah, thank you for taking my question. Specifically on the cardiovascular, just taking cues from the earlier participant.
Sorry to interrupt. Padmanabhan, you're sounding a bit muffled, so if you're using the speaker mode, may we request you use the handset mode, please?
Yeah, can you hear me now?
This is much better. Yes, sir. Please go ahead.
Yeah. So yeah, this is with respect to the cardiovascular intermediate, taking cues from the earlier participant. I mean, our client is listed and, if we look at the commentary of the label extension, so in the US alone, they talked about, potentially additional 50 million and Europe would be incremental. So in that context, I mean, FY25 definitely we see good growth. But if you are looking at peak, sales in the US and also with Europe, how do we see, say, in the next 3 to 4 years specifically with respect to this molecule, both in terms of scale as well as in terms of profitability?
It's very difficult to predict how a molecule will behave. And but all that we can say is that the data was presented to the FDA, and the data was also presented to the American Cardiology College. And both institutes, which are institutes of international repute, there is very high acceptability of this data. Because of the acceptability of this data, the molecule is now indicated not only for secondary use, but as a primary treatment product. So now it is used to address the primary indication. And that's the reason that, like you mentioned, that the addressable population goes up by 50 or 60 million in the US and maybe even higher in Europe and other markets. So I think as far as the molecule is concerned, there is today no other oral product which can act as an adjunct to the statins. So there is great potential, and we reckon that this would be a blockbuster.
Sure, sir. And with respect to, the profitability, and second is, sir, given that this is the only non-statin used to reduce the cholesterol, as you had mentioned, I mean, I would, with respect to, vis-a-vis what the client earlier had, requested in terms of capacity, has there been any kind of an upward revision in the, kind of volumes that we're now talking about?
See, there could be an uptick in volume, and as BlueJet, we are prepared to address that. The capacity that we have created is not only for this product. The block that we have built has got a very large capacity. So should that be an uptick in volume because of the primary indication that it is now valid for, I think we are well positioned to address that upside. But beyond this, I think it's not prudent to comment.
Sure, sir. And shifting to the, the CMI segment, if I'm correct, one of our clients had taken a, plant shutdown to expand capacity. So it might have impacted our numbers in the last couple of quarters. I mean, but the expanded capacity should benefit, is when is it expected to start, and how do we see the benefits, probably in the next couple of quarters?
We see a slowdown even for one more quarter, and maybe we should come back to our historical levels from Q3 onwards, actually. I think that is when we expect the volumes to pick up.
Sure. So one final question before I, get back into the queue. With respect to, the overall business, I mean, we have seen some kind of, lower than expected offtake primarily because of various issues, or various hurdles across segments. With volumes picking up big time, I mean, if you are looking at various tailwinds, what should be the kind of margin expansion that you would be looking at, with the operating leverage?
Yeah, I think you pointed out well. I think we are all aware of the short-term impact, but if you see the big picture and the several tailwinds for this particular segment, the outlook is fairly positive. And we are also further backward integrating in Unit 3 for a particular key intermediate. So going forward, since this is already backed by multi-year supply agreement, by using our own intermediate, we will have good control on already a very profitable product.
Sure, thanks a lot, sir.
Thank you. The next question is from the line of Bansi from JP Morgan. Please go ahead.
Yeah, hi. Thanks for taking my question. My first question is on contrast media. So Ganesh, you mentioned that probably this impact will continue for the next 2 quarters. So fair to assume that our fiscal 25 run rate will be similar to our fiscal 24, because I'm assuming the newer products also probably will start contributing or probably will be in the phase of ramping up. So any color there?
Yeah, I think as a segment overall, of course, there's a short-term impact, but the newer advanced intermediate will act as a very good buffer to see a potential growth in this segment for the next financial year.
Okay, and this is both for so you mean to say the advanced intermediate in ironated space and in the gadolinium space, the NC molecule, both will equally contribute? How should we think about product opportunities between them?
Both are highly credible candidates. One is an NCE which is gaining traction in the regulated and semi-regulated markets, and the other ironated molecule is a well-established, growing at a double-digit annually in the end market. So, most important milestone was this validation for the ironated intermediate, which the company has done successfully.
Okay, so that should basically drive growth in CM business in fiscal 25 over 24, despite the impact of plant shutdown on one of your products.
That's the endeavor, yes.
And the second question is that, on unit 2, Vicky mentioned, it is ready and on stream. So when should we start seeing commercialization of, product here? So, I mean, is our sales today constrained because of, this plant not being validated, and now that it's done, we should now see a spike? How should we think about the ramp up here?
See, in quarter 2, FY25, we should see an uptick in the supplies that we are making, because the new capacity, the larger capacity is getting on stream.
And this capacity will be, multi-fold of what our current existing capacity, or what quantities we could be selling right now?
Yes.
Okay, got it. And between our, segments, contrast media, artificial sweetener, and, PI API, fair to assume that gross margins are broadly similar?
Contrast media would be slightly higher. The PI API and artificial sweetener will be similar.
Okay, so next year, if you are expecting higher growth in, say for example, PI API because of the wrap up of the product, how should we think about gross margin?
It should be like whatever current level we are having, maybe it may go down by 1% or 2.
Okay, and you also mentioned about augmenting, your team in terms of, adding capabilities in R&D and elsewhere. Should that have any bearing on your employee cost?
Yes, if you see our numbers, FY25, the employee cost is significantly higher, but then our sales are also increasing. Even in FY25, we would be adding some people, both at the senior management level and at the execution level. We'll be also, increasing our R&D further. So we are gearing up to keep in step with the growth that we envisage.
Okay, got it. I have more questions. I'll join back.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi. Good evening. Thanks for the opportunity. A few questions. One is, can you talk about our CDMO? How is the pipeline looking like? In the initial commentary, you said that there are a lot more interactions which are happening. But any sense on how is the RFQs or how large is our pipeline currently? Some indication if you can talk.
You mentioned RFQs or RFPs, and that's a very valid point that you brought out. Given the environment that we have today and the tailwinds that we are, experiencing, A, as a country, and two, as a boutique CDMO, I think the RFPs that we have is 2x of what we used to have. Speaking of the pipeline, I think in all three segments, we have a deep pipeline. Contrast media, we are looking at new products as well as forward integration. So that gives a lot of depth to the pipeline. In the high intensity sweetener or artificial sweetener, there also we are working on 2 or 3 very credible opportunities, some large opportunities, which will add to the current commercialized product. On the PI API side, you can see traction already. I mean, the opportunities that got incubated 2-3 years back are now fructifying. Going forward, we have a strong pipeline as well. A couple of launches would happen in FY25. As I mentioned, that we have added a couple of chemistry platforms also, new chemistry platforms. Based upon those platforms also, there will be some new products that we will be developing. How soon they will, get to industrial or commercial scale, that we have to see. But as far as pipeline is concerned, I think we are in a very good place, and the R&D pipeline is well poised to drive growth.
Okay, just one continuation. On contrast media, if you look at the global supplier base, we know one of the large players in India. But other than India, how do you see the competitive dynamics in this space? Are there more players coming in, or is it like the level of competition is largely plus minus 2-3 players, but largely stable? How should we understand? Because the profitability, what you enjoy, as you said, on the gross margins and all, it looks very favorable and a very large growing market. So are there more players coming, or how should we understand here?
Yeah, so I think the industry is fairly consolidated. Wherein 4 key players have about more than 75% of global market share, and for the past 10 years or more.
Sorry, Steven, I was more trying to understand from the suppliers of the API. On the formulation, we understand it's a largely consolidated player, but in terms of suppliers of intermediate API, how do you see the scenario?
No, so the ones who are formulating, the 4 key large players, are also manufacturing APIs today. And there is a strong sense of drug-device coupling in this, and that's one of the major reasons. They have solid control on the API and also medical devices in some cases, so which has helped them to maintain this market share for the past more than 10 years. And in the balance 20% market share, yes, there are a few Indian players that have entered, and there are multiple players in China for the iodinated set of molecules. How we are working differently is, of course, working on established key customers and also innovating on their NC side, on the MRI space. So we will always be marginally ahead of the curve, even if there's a strong generic competition kicking in.
Okay. And last question, can you talk about our revenue from top customer, top 5 and top 10 customers for FY24?
It's pretty much the same. Like our stress is concentrated with 3 major players in contrast media. And the addition to that list is the new innovator in the PI segment. Apart from that, technically there is no change in the customer mix, but for the PI customer in the innovator customer.
Can you provide the percentage revenue contributions from them, top customer, top 5, top 10, which we presented in our DRHP?
No, we don't share that actually.
Okay, fine. Thanks. I'll come back to it.
Thank you. A reminder to all the participants, if you wish to register for a question, you may press star and 1. The next question is from the line of Ritika from ValueQuest. Please go ahead.
Hi, sir. Good evening. My first question is on contrast media. When we see the export data, we saw much lower shipments of one of the large drugs, of course, due to plant maintenance at innovators' end. But in terms of revenue booking on a QOQ basis, we saw flat revenue. So, could you please explain how did we book the revenue, or how does the revenue booking happen?
See, in our case, the supplies to the key customer in contrast media is on a DAP term, which is delivery at place. Technically, unless the material reaches the site, we cannot actually recognize as sale. Okay? So generally, in accounting term, we call it as sales cutoff. What has happened this quarter is the sales cutoff of previous quarter got recognized in this quarter. Okay? So that's why you would see, like if you see the data, export data, there would be what we would have recognized will be more than what is dispatched. This is because whatever dispatched in the previous quarter actually gets into the recognized as sale in this quarter.
But that would be rolling on a quarter-on-quarter basis. Even last quarter, some sales from the previous quarter would have got recorded.
You are right. The challenge is this quarter, what I mentioned, since the offtake is a bit lower, the cutoff is also coming down. You understood?
No, sir. This last bit, can you please explain?
See, this quarter, our dispatch is lower. Because of that, even our sales cutoff is very much on the lower side. That would actually have an impact in the next quarter. So this quarter, we don't have an impact. In terms of revenue recognized, you will see some impact in the Q1 of FY25.
Got it. But there is nothing to do with inventory at our warehouse.
No, nothing of that. Yeah.
Got it. Okay, thank you. And last question is on CapEx. We have guided for a 200 CapEx for 25 and 26. Could we get a split of this 400 crores between Mahad and the new Greenfield Unit 5?
It will be more or less equal. I would actually put it like that.
Got it. Okay, that's it from me. Thank you so much.
Thanks.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Pradeep Rawat from Yogi Capital. Please go ahead.
Hi, good evening, sir, and thank you for the opportunity. So I have only one question. We have spent over 200 crores this year, and we are guiding for 200 crores for next year and 200 crores for the next year. So what kind of fixed asset turnover should we see for these capexes?
I would actually put it in the range of upwards of 3.
So currently we have a asset turnover of 4. So why we are estimating it to be in the range of 3?
So this is actually like today what you are seeing is a depreciated block. So like when you actually do the new capex, it will be around 3 actually, upwards of 3, which according to me itself is a excellent ratio.
Okay. Thank you. That's all from my side.
Thank you. Participants, you may press star and 1 to ask a question. If you have any further questions, you may press star and 1. Our next question is from the line of Kanishka Sarkar, who's a private investor. Please go ahead.
Hey, hi, good evening to all of you. So I just want have one understanding. So, of course, we went through a little difficult times, after that, and all, and now we are kind of gearing up to invest a lot of money. I have just one simple question. So as a company, post IPO, there is a great sense that we are changing the gear in terms of growth. So I just want to know, from the manager's perspective, with the investments we have done, doing currently, and which is planned in the next 1 year, when do you see the inflection point? Which is that part, or in terms of time, maybe a year down the line, months down the line, where do you see the inflection point where we actually ramp up the growth and we move into the higher trajectory?
Yeah, I think capacities would be kicking in different phases in this financial year as well in the next year, but full extent would be seen in 26, 27.
Okay, right. Thanks a lot. Thank you so much.
Thank you. The next follow-up question is from the line of Ashwik Jain from ICICI Securities. Please go ahead.
Yeah, sir. This is Sanjesh again. Thanks for taking my question. So just touching upon this revenue recognition which you mentioned on the DAP basis, I thought we are also managing the supply chain for our largest customer. That means we should have built certain inventory at our warehouse and we deliver it on a just-on-time basis. How does that varies from this revenue recognition what we are talking right now?
Sanjay, you have to, when the customer, when his offtake goes down, okay, in a particular quarter, we don't actually produce and stock it.
Okay.
So to that extent, even our production goes down. So there are two factors. During this quarter, our total actual production is on the lower side, okay?
Okay.
And whatever positive benefit you are actually seeing is because of the cutoff which came from the previous quarter, okay?
Okay.
This quarter, our finished goods is very much on the lower side, and if this impact you would see only in Q1 of 25.
Got it. So when should we see the normalization of supply to the largest customer? When should that happen?
In our estimate, it will be Q2.
And second is on the APD prices and its impact on the realizations. How have they behaved?
There is actually a reduction in the APD prices, marginal reduction during the year, and Shivan can take on that.
So I think with this backward integration play, I think we would be able to further improve the profitability of this major product. But overall market is, in terms of the sourcing, has been very favorable when it comes to APD prices. Interestingly, I would like to take this opportunity to explain further. From this particular backward integration block, there is an opportunity to sell to other contrast media players as well. But the idea is to first use this quantity for our consumption and then perhaps pitch it to the other key players in this space.
Okay. So we are still, I thought APD prices should be too low for us to make any large economical benefit out of that APD plant which we are trying to put. We still see the economics being favorable for being a backward integrated facility?
I mean, the kind of continuous manufacturing that we are trying to develop in this particular block will definitely drive better efficiencies for us as a company.
Got it.
The strategic independence is also important because in the year 2021, there was a big impact on the APD prices. So cycles like this in this current world do happen, and we will still continue to, of course, manufacture our own APD, but also outsource some quantities to keep our existing suppliers in play.
And any plan for further backward integration in our new product for the PI API segment?
I think we are very much covered in terms of the supply chain when it comes to the PI product.
Okay. There we are not looking to further backward integrated product.
We start from the very basic chemicals, Sanjesh. So,
Okay. So you're telling we are fully backward integrated already. So there is no meaning in going into the commodities.
Yeah. Yes.
Got it. Got it. We have slightly increased our capex outlay for 3 years. I thought we were at 500 odd crores. Right now we are 600 crores. What has changed? It's just the cost of putting up capex has gone up, or how is it?
The cost of capex has remained the same, but at the same time, I would request Mr. Ganesh to add on.
We are keeping a slightly larger outlay for Unit 4. That is, we will be replicating quite a few capacities. One as a risk mitigation and also taking care of the higher needs of the customer. So the plan for Unit 4 could be slightly larger than what we envisaged last year.
That should lead us to a much larger capacity. Are we confident of placing? Because I don't think our largest customer is looking to grow more than 5-6%, at least that's the ambition, and the guidance they have provided.
I think these molecules are not only built for the next few years, but the next decade. Seeing that view and having a strong business continuity plan in place, I think this is well appreciated.
But because will this hurt the margins for us? Because we will be utilizing much lower capacity initially to start with, and then probably ramp up over the years. Will it have any major implications on the margins?
So we tried to. I mean, as a company, we've at least demonstrated good abilities in capital management. The endeavor would be to also have a multi-purpose nature in these blocks that we design in the short term, but keeping the long-term strategy in place. So it's better to have an additional capacity, is our understanding.
And Sanjesh, just to add on, we also need to keep the capacity in place for certain proposed launches. Like if we succeed, maybe our capacity should be ready in place at that point of time.
Got it. Fairly clear. Thanks for answering all those questions patiently, and best of luck for the coming quarters.
Thanks, Sanjesh.
Thank you. Our next follow-up question is from the line of Bansi from JP Morgan. Please go ahead.
Yeah, hi. So the sweetener business, we see, sequentially this has picked up. Last quarter you had mentioned about launching a new product in this segment. So where are we on that? And should we expect, this to be now a new base for a sweetener business?
Firstly, I think yes, the saccharine business is progressing fairly okay. The other sweetener that we spoke about is currently at the pilot stage. We are trying to optimize a few things, but you will hear from us if there's any positive update. But results so far are fairly encouraging. Okay.
So unlikely that adds to, your revenues in fiscal 25. I mean, the launch could potentially be in 26.
It could be, but it won't be a major needle mover.
Okay. Understood. And for our PI API, if you can talk about any other molecules that we are working with innovators, which could be at advanced stage?
There are a couple of opportunities that are at a very advanced stage in the CNS and the oncology side that we are tracking with the innovators. And as it moves ahead, we will definitely share some updates on that.
Okay, but you think there's some time for those to get commercialized?
Clinical data is fairly positive of our end customers, and we believe that they could have a better solution to overall patient healthcare going forward.
Okay. And on your CVS product, as the volumes ramp up, and probably, if at all the innovator also kind of, increases the, offtake, what happens to the realization? Do they remain the same generally?
Some efficiencies will certainly kick in. So because, if the volumes go up, then the plant one line will be working as a dedicated line for the product. The batch size will be much, much larger than what we do today. So certainly some efficiencies will be there. So, which should go straight into the bottom line, into the margins.
Okay, but so those are your process savings, but from the innovator side, the realization, that does not change.
The product is patented till 2032, so that's the advantage of being in a patented space. Generics will not be hitting. So if that's the thing that you are trying to hint or indicate, you don't generic pressure coming to 2032 in the advanced markets.
Okay, understood. Thanks.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
We thank all the participants and hope we have addressed all your queries. We will meet in Q1 results. Thank you.
Thank you. On behalf of Blue Jet Healthcare Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.